maybe we can just get started. So everything is online. So thank you everybody to join the panel. So the topic we're going to talk about fixed income product. So the current stage and also how it will be developed in the future in the DeFi space. So maybe we can get started probably 30 seconds, 1 minute to introduce each of you. Maybe we can start from left to right, from Sid.
Yeah, sure. So hi, I'm Sid. I'm from Maple Finance. So we are a decentralized corporate debt marketplace. We provide corporates and institutions within crypto with access to capital efficient borrowing from liquidity pools. So our borrowers include trading funds, market makers, exchanges. And then on the other side of our marketplace, we've got liquidity providers who benefit from diversification, high yields, and insurance from our Maple token. And then the convenience of not having to select each borrower that is able to lend from liquidity pools.
Good. Andrey?
Hi, I'm Andrey, and I'm founder of Opium protocol. And basically the protocol is the protocol for the financial derivatives or analogs of financial derivatives which exist in traditional finance. And we designed it 3 years ago, first time, and it was no DeFi, therefore we designed it very alike traditional financial system. And now we are composable with DeFi, very happy to be composable. And it's very interesting to see how the whole DeFi is moving and where it's going. So happy to discuss.
Thank you. Okay, Stani.
Yeah, I'm Stani. I'm the founder and CEO of AAVE. So AAVE is a decentralized money market protocol where you can create new money markets with reserves for lending and borrowing. So essentially, as a user, you can deposit cryptographic assets such as stable coins and earn interest on them. And when you are depositing into AAVE, a credit line is granted to you that you can exercise and borrow another asset, or you can delegate this credit line to someone else you trust, or to another smart contract, for example. And I started personally building smart contract-based financial applications from 2016, and happy to see the whole space growing so quickly and so fast. And I'm actually, I have hard time to follow all the crazy and interesting, magnificent stuff happening.
Okay.
Super happy to be with this crowd here today.
Okay, thank you. All right, Tyler.
And I'm Tyler from BarnBridge. We are a relatively new protocol, but the concept of what we created is about like 1.5 years old. We needed the ecosystem to develop a little bit to allow for a protocol like ours to exist, because we exist essentially on top of protocols like AAVE, Compound, Maker, and some of the bellwethers or titans of the industry that came before us. And what BarnBridge does is it allows you to tokenize risk and reward. So essentially, as you, if you think about the way that a digital asset would change in price, it's either going to change in price due to market price fluctuations. So either market prices going up or down, which is known in traditional finance as alpha. And then also the income stream from an asset. So like we learned in finance in college that an underlying asset is essentially the future value of cash flows. Well, those cash flows can be yield, like we're seeing in DeFi right now. They can be dividends, they can be rent. And so the amount of yield that you get from a product, or the interest rate, that can obviously fluctuate, and that will change the underlying price of an asset. And so BarnBridge also tokenizes that risk as well. So the two main ways that you can essentially change or adjust the underlying market price of an asset, you can hedge against those risks using tokenized derivatives with BarnBridge.
Okay, sounds good. So then I'm going to start next round of questions. So I'm going to ask each of you. So maybe you can have more details about what's your logic for your protocols or products. So let's start from Stani. So then I recall last time when I talked to Stani is 1 year ago. So then probably in November, after you delayed your mainnet in October. So the before your mainnet in January, and also the before everybody know you actually notice your project. So then we have a discussion about how you're going to do the money market protocols, how you compete with Compound. And then Compound was kind of large and also maker. So then somehow after January, the mainnet, I noticed your project all the time. So then from the TVL, a couple million to 100 million. So at that time, before Compound actually have their airdrop of the token, they couldn't money. Then Compound surpassed you to a couple 100 million. And then the current money started. So from YN, so everybody get excited and total value locked in DeFi boomed to right now probably over 10 billion. So then you have a lot of progress. So then when I search you actually everywhere on YouTube. So then I watch a lot of MA from you. I'm not going to repeat all those questions. But the key questions I want to ask. So during the short time of 1 year, what's the key things you did right? So then to bring you to current actual status. For example, one of the top DeFi projects and provide a lot of help to other protocols on top of you. So what's the key things you did right, you think, to bring you to current stage?
Yeah, I think the key thing probably is that the protocol is quite developer friendly, in the sense that it's quite easy to build on top, and AAVE as a protocol, it really basically kind of like does one thing very well, which is holds the assets of the underlyings and gives the representative in a form of token to whoever deposits, whether it's under a smart contract or user. So I think that has been like, and the documentation reflects the easiness and simplicity quite well. And I think one of the things that we kind of understood that when we came to the market with the AAVE protocol, that Compound was quite big and very successful on what they were doing. And we wanted to somehow also like provide more alternative ways of doing things in what there was already in the market, and kind of like provide a different offering in that sense. And that boils down to different assets that we listed in the very beginning of the protocol, and the way we structured the A tokens, for example, how they differ from C tokens, with having increasing balances, which is more focused on the kind of like an end user experience and more kind of like transparent view on how you're earning in the protocol. So that's probably like quite important, and also that we added natively the flash loans. So those kind of like help a lot. But I guess also like we're very friendly as a project, so we try to work with everyone and help everyone in the space. So okay. I think it's the culture that is important, because we tend to always think that when we build decentralized finance, that it's only the code that you deploy and the tweet that you or the Twitter storm that you create that matters. But actually it's very much more about human composability and just kind of like sharing thoughts and helping other people in brainstorming and it's many cases in AAVE when we are like working with other people, we're trying to actually find ways and solutions on their products and what makes their product better, and maybe that has been helped a bit in the network effects. So I think that has been, and one important thing is the branding, is that we always kind of like we're very particularly using quite a lot of memes and that kind of stuff. So it's really, I mean, the identity has to be in the branding as well. So that has been, I don't want to say that the success is on memes or anything like that. It's just, it really helps to strengthen the messaging, I think.
Okay, sounds good. So let's move on to Sid. So I think your project actually is also targets the debt market, and so for people how to get access to capitals. I know you from a traditional banking system, so maybe you can give us an overview how the traditional capital market works, and then what's your project's value proposition to the DeFi? How do you think that your project, how to target the debt market?
Yeah, yeah, no, good question. So, yeah, I came from a background in traditional capital markets, and in that space, it's very much geared to larger companies that would be accessing borrowing by issuing bonds. So in a traditional capital market, you'd go through an investment bank, you'd pay a pretty large fee, and then you'd end up with pretty limited sort of regional distribution to investors. Whereas I think the opportunity in DeFi is very much that we can use, first and foremost, we can use smart contracts to automate out a lot of those fees, which means that this is therefore a much more accessible product or an accessible way to access finance for smaller companies and smaller projects that are in the earlier stage of their growth cycle. So this is particularly important for companies in the crypto space, like those ones I mentioned before, which would be, trading funds, miners, market makers, exchanges, even new ventures, because they really need access to capital to fund their growth, to invest, and in a lot of cases also to pay for operating costs. But the other thing we're able to do versus traditional capital markets is that because you're accessing funding from the DeFi ecosystem, and you're using liquidity pools, we're also able to offer a much faster speed of execution. So you can get the funding much faster because the liquidity pools already have the funding that you can access. And then you get instant access to global distribution because you can get any participant from around the world rather than just a limited set of regional investors who can finance you. So I'd say those are kind of the three main things. So it's really access for smaller companies and newer companies, and then global distribution, and then lower cost. And then, compared to CeFi, it's worth noting that really what we're providing, and the main killer feature is this capital efficiency. So you no longer have to borrow by putting down $150 worth of collateral to take out $100 worth of debt. So you can really borrow it like, if you have a strong reputation, you can borrow at 50% collateral or even less.
Okay, we will come back to the unsecured loans a little bit. So let's move to, two of our hedge fund guys. So Andrey and Tyler. So they are very experienced in derivatives and also structured products. So they have different way to target areas. As Tyler mentioned, right now the DeFi is dominated by variable interest rate. But in institutions like fixed, they don't want to uncertainties. So they have different ways to target that. So maybe we can talk about Tyler. So what's your thought actually to design your protocols to target these areas? For example, variables interest rate to fixed interest rate, and also particularly how the structured product, your alpha bonds, work in traditional finance, how that can be applied in DeFi.
Yep. So I think when you look at something like synthetics, what it is even the reason it's called synthetics is in traditional finance, you would essentially call like a synthetic of an asset or something built off of an asset a synthetic, right? And so when you talk about the global derivatives market, that's like $200 trillion. Most of that global derivatives market is actually on the yield side. So like if you look at like Wall Street, they would say like, if you were like they like made fun of it. They would say like, you're going to equities in Dallas, right? Like if you were working on like the debt side, or if you were working on the actual underlying equity side, it was almost made fun of because like the real money is in yield. The real money is in the cash flows, right? The synthetics will be different in crypto because synthetics is actually going to end up being like a primitive, meaning people will build on top of synthetics. So like where the concept of like what an equity actually is can't be, it's not like trademarked or patented. In crypto, you actually have to have someone build the structure for things to actually work that way. And so synthetics is going to be like far more valuable than like what equity offering. I mean, not that that's like not actually a powerful component, but like if you truly look at Wall Street, most of the money is still in yield. So when you look at something like AAVE, when you look at something like Compound, when you look at something like MakerDAO, they're essentially all offering different interest rates. And even if they offer fixed interest rates, those fixed interest rates are also going to vary, right? And that's no different than the way that current Wall Street works, right? Like all of the massive bellwethers on Wall Street, they will go out and issue bonds, or they will work with companies to essentially structure bonds, bond structuring. I mean, like that's how JP Morgan makes money, like has become such a successful company, is that they're actually creating structured products for people, right?
Yeah.
And so, but all of the trading volume that happens on top of that, when you talk about like mortgage-backed securities, like collateralized loan obligations, essentially derivatives squared, and then there's also derivative 64, which is derivatives built on top of derivatives. Those things get extremely hard to track, right? Like it's very difficult to know what is actually in those contracts, like not smart contracts, like actual physical piece of paper contracts. And I worked for a subsidiary of JP Morgan back in 2012, and it took them almost 4 or 5 years after the financial crisis, like the smartest people in the world, to even figure out like what was on their balance sheet, right? But with smart contracts, on the contrary, it not only allows you to track things downstream, like where we think about risk from these derivatives, right? Most people know what a mortgage-backed security is because of the fact that everything blew up in 2007. But mortgage-backed securities weren't started in 2007. I mean, those have been sold since the 80s, right? And they are actually a massively effective tool in terms of how you can essentially manage risk across all these different like housing markets in the United States. Where that got screwed up was some people that were extremely intelligent figured out how to also create credit default swaps paired with those things. And they essentially created what are now known as like weapons of mass destruction in the financial industry. The reason for that is because nobody could actually track the risk downstream, right? The beautiful thing about crypto and smart contracts is that that will happen, right? There will be, I was telling people when I was first starting BarnBridge, like there will be another MakerDAO. There will be numerous MakerDAOs. There's AAVE, there's Compound, there's MakerDAO, and there will be more lending protocols that come in the future, right? There will obviously be ones that win. AAVE because it has a ghost meme. No, but for a lot of different reasons, right? But the reason that crypto is going to make this so beautiful is that when things get built on top of these lending protocols, we're actually going to be able to track, like using both algorithms like algo traders, and then also just visualizations like Zapperfy, right? We're going to kind of know like what is going on. Like, is AAVE over collateralized? Like, is synthetics over collateralized? Like, what does this look like? And then there's going to be arbitrage opportunities in the industry where one protocol is lending a rate at another protocol and you can short something on this protocol. We need liquidity for that to happen, right? Like even for BarnBridge to be able to exist, I needed like multiple MakerDAOs, right? Well, in order for us to start being able to create like truly market neutral strategies, for us to be able to create like extremely unique synthetic trades and things of that nature, then BarnBridge and a couple BarnBridges, right? Like Maple Finance, what I actually started looking into what Maple was doing, and within like 10 minutes, I realized like a way that we could integrate what we're doing with what they're doing. There's just essentially integrate all of these pieces. That's where the concept of what money Legos came from, right? And so where I really got so bullish on DeFi and why it is so much more efficient than the other markets is the transparency. But then a lot of people who doubt DeFi, I think I got really bullish when MakerDAO hit $100 million in TVL. But then when I saw Hayden hit $10 million of trades on the on an automated market maker, when I was in New York, like last April, I realized immediately that the value of being able to trustlessly execute transactions across an entire ecosystem cuts out so much middlemen and middlewomen and work and paperwork that if you look at the way that I'm almost done here, I'll get off my like diatribe. But if you look at the way that like yield, working capital will always chase higher yield, assuming equal risk, right? Even going back to like biblical times. And the beauty of these smart contracts is that when you're dealing with like interest rates globally at like less than 1%, like 0.5%, like 50 basis points, like you get to the point that you're essentially talking about a 10% basis point improvement in efficiency means that literally all debt in the entire world will go to blockchain long term, even if it's just 5-10 points of improvement in efficiency. And that's because working capital will chase the higher yield. If you're talking about $100 billion or $1 trillion of debt, 5 basis points matters a lot more than people think.
Okay, sounds good. All right, we'll come back on that. So then let's talk to Andrey. So then looks like Opium network has different solutions to that. You are on level 2 solutions, build different derivatives if you think that will fit in the market. So then you already built a derivative interest rate swap deck, and also you launched your first credit default swap on AAVE, and also you have also gas options sort of. And so then actually, how do you think that this kind of traditional derivative markets work in DeFi? How that can be improved or hedge this kind of risk for people who want to do that?
Yeah, that's a good question, and it's interesting that we come here from spot markets. Then Stani spoke about money markets, and that how it goes in traditional financial system. Then it's credit money, and then it's derivatives. And every time you go further, it's like 10 times more. The market is 10 times bigger, and derivatives are the biggest market, and they allow to trade risk and hedge risk very efficiently for the system, and they allow that's one. And another one, they allow to be more capital efficient. So not only because your collateral, like in Maple, for example, because you have 50% of collateral, but also because you can reuse the same collateral for several things. It's not with me, for sure. Oh, yeah. I was scared for a second. That's pretty cool feature of derivatives, that they can bring capital efficiency without extra risk, or with extra risk. And there is a slight problem, because if everything goes well, derivatives are pretty cool instruments, and risk can be calculated, as we just discussed, can be transparent. You bring more capital efficiency, and you can hedge risks that you don't want to run and accept risks you want to run. That's all fine. But the problem starts where you run correlated risks, for example, for the same collateral. And it's very difficult because it's easy to say if two risks are correlated, it's easy to say, but if it's two synthetic risks, which nobody understands, like JP Morgan style 2007, then it's very difficult to say is it correlated or not. And that was the problem with the CDOs and housing market. It can happen in DeFi, but I agree that it's much more transparent. So the key thing, I think the key point here is that derivatives should be collateralized, and it should be transparent what kind of risks you take for the same collateral. If it's not correlated risk, if it's fair collateral, then the risk is basically going out of the system. But it's also well possible that it's going to be a lot of correlated risks for the same collateral, and actual collateral is not going to be full collateral. It's going to be part collateral based on historical volatility and measures and so on. And then we're going to run into the very big financial crisis in DeFi. So I think that's very tricky. And we run, for example, as you mentioned, the CDS for our credit delegation, and it's a good example because it's fully collateralized. So actually there is a real guarantee, and so there is a real collateral, so which you can claim if something goes wrong. But it's also different risk. It's a credit risk. So, and if you mix it with the market risk, for example, of your Y-earn tokens or A tokens or whatsoever, you use those tokens as a collateral. You basically accept two risks for your collateral. So one risk is going to be market risk of AAVE, and you get reward for it. But another risk is a credit risk of that specific credit delegation or specific issuer. And that's what I mean by very capital efficient solution. So you run two risks, you run two returns, but because risks are not correlated, market risk and a credit risk are completely different risks. So your risk return profile improves dramatically. And that's a good example how derivatives can help DeFi. Another example, the bad example, if you run 10 correlated risk for the collateral, which is not 100%, which is like 30%, and then you put 10 times return and 10 times of correlated risk, then it's very dangerous, and that's very dangerous leverage that will kill it. So, but again, I agree that transparency is the key here, and it's very easy to audit it.
That's good. Thank you. So then let's go back to Stani. So then actually, I know you read another 25 minutes and also target next phase development for AAVE, and also you already is migrating and then token to AAVE token, and also fully decentralized DAO structure. So then you also target the unsecured loans, so improve the efficiency of the capitals. But right now in DeFi, it's very hard to integrate credit risk and also credit into it. So then what's your thought actually in order to target unsecured loans, what kind of components is missing in DeFi? In order to do that and to lower the collateral level, so what's your thought to complicate that?
Yeah, I think like the reason why decentralized finance is over collateralized, or let's say mainly because, I mean, in the nature that you know, users aren't traceable, or you can't attribute, let's say there's no recourse. That's the kind of like starting point of where DeFi has begun. And especially like in a few years ago, you know, you always like built DeFi and in a way that wasn't that optimistic in terms of like risk, not just credit risk, but also systemic risk. When we were developing, for example, ETHLand back in the days, we didn't have any intention to have lending pools, because we were thinking that we cannot put users in the same kind of like a basket by using collaterals that are not that liquid, and this is very early in those days. And I think what Maker and Compound did and Uniswap did well is that they actually combined the liquidity, and as the liquidity started to actually become more mature and deeper, and you could actually have this kind of like a pooled risk model. So DeFi became like less optimistic in that way, and I see now we're going towards more optimistic. So I think we're going now more towards this optimistic road with, for example, with the credit delegation functionality that AAVE has, or for example, Maple's way to actually grant basically this kind of like a bonds, loans, and for example, in terms of credit delegation, what we are doing is that we kind of acknowledge that 75% of the AAVE depositors, they basically are just depositing to earn, and they're not exercising any credit. So there is a lot of value there that could be used by someone else, and someone else could actually even return that loan. And what we tried to do kind of like as a in-between step is that with the credit delegation, when you delegate credit, the protocol itself the risk doesn't increase in the protocol because the collateral is set there by the depositor, and the basic default risk will be on the credit delegator in that sense. So that person is taking the credit risk. And for example, Opium is a person who can actually, a protocol who can kind of like insure this risk, and you can do also tranching and a bunch of other stuff with what BarnBridge is doing. But the idea here is that it's a way kind of getting out of this model that you need to always over collateralize each and every single position, and that introduces kind of like a credit-based loans. So you can delegate your credit to someone else. It could be like a OTC lending desk, which for example happened with the very first credit delegation with the Diversify, or it could be a smart contract. For example, Wire's YA Link Vault, they're borrowing 20 million worth of USDC, and taking that USDC and depositing it elsewhere to earn more. So you could actually create like this closed loop systems where there is no credit risk, because you know what the smart contract is doing and what is it capable of doing, and all the terms and conditions in that sense. And I think what we're also trying to achieve is that more traditional financial systems could, because eventually like the DeFi space will grow, the liquidity will grow quite a lot. And I mean, it becomes a pool of liquidity that it is accessible by anyone in its permissionless nature. And I think if the growth continues this way, it also means that it becomes a liquidity source for traditional finance. And what we're trying to achieve with the credit delegation is kind of like open the gateway for different entities and different traditional market participants to source their liquidity from DeFi and inject it into the traditional finance. And eventually, the long term could imagine that someone who is buying a house, part of that liquidity could be sourced from decentralized finance. And then the other thing we're working quite heavily is getting real assets into the money markets that we have. And the cool part about AAVE is that what differs us from Compound and Maker, for example, is that the pools that or the money markets that you create, they are in silo from each another. So you could create a more riskier money market or less riskier money market, and or you can create a vault that deposit half of the deposits into the riskier and less riskier. And this is going to be very interesting, like risk arbitrage in the future. This is how basically how we see like the collateralization, over collateralization.
Okay, sounds good.
May I interrupt a bit and just comment, because it's really interesting what Stani said about different risks, but also about the credit delegation. That's concept, but basically that it can be professional players who are able to assess the risk and who are able to guarantee something. And there's less professional, or let's say retail users who just want to use the product and they don't want to understand all those risks, and they don't want to choose. They don't just want to have a guarantee, and they able to pay for it. And they pay for it for more professional players. And that's, I think, happening in the traditional financial system. And that's pretty natural. So we also, for example, in Opium, we allow those professional players to connect on layer 2 with meta transactions and just make market there. And it can be 10 professional players, and the end user going to just see the quotes and so on. With credit delegation, it's pretty the same. And I think it's a very interesting concept. If DeFi would move there faster, I think it would be easier for users and for them it's to pay 1%, 2% extra for this guarantee is easier than to understand all this complexity and audit all this complexity. But professional players at the same time, they can assess it very, very good and earn this couple of percentage for issuing the right guarantee at the right price.
Yep. So the Taylor is talking, so then probably I will move ahead for Taylor and also Andrew. So then actually you are target a very sophisticated derivative market, and also those derivatives need a kind of knowledge in terms of the, for example, structured product, understand the risk, and also the structure of the derivative instruments. Do you think that the current DeFi sectors is mature enough to accept those very complicated derivative markets? And also, liquidity is a very big concern in those instruments. So usually in traditional markets come from OTC market and also standard markets. Some of the exotic instruments traded on OTC desk. So then how you think about, for example, the market is mature enough to accept that complicated derivatives, and also where to source those liquidities for people want to trade. So maybe we can start from Andrey and Tyler.
Well, then I'm going to be very short. I already expressed the view that liquidity can also come from these more professional players, because they are able to stake money and liquidity and their knowledge, their professional expertise in order to earn on it. And retail users, they will not mind to pay for these services, and they don't need to deal with this complexity. So I don't think that retail users will, I don't think they should, but I also don't think they will ever be able to understand very sophisticated trading strategies and options and so on. So some strategies like really need to have PhD. So I think this split for the retail and more professional players, again, is natural, and the liquidity also can come from there.
Okay. Yep. Tyler, what's your thoughts?
I think the products that we're creating for BarnBridge is the first two introductory products are simple enough, and there will be demand for them in the market. I mean, the first one is we're pulling, so like our smart yield product, we're pulling in liquidity from like already existing protocols. Like we're not borrowing and lending. We're essentially like taking yield from AAVE along with like Compound, so it'll flip between them to go after whichever interest rate is like the variable interest rate is higher that day. And what we're doing is we're setting up essentially pools that allow you to sell off risk to essentially like a fixed yield. So the way that it would work from like a UI perspective is you would either just log in and say, no, I want to stay in the variable yield, but I expect interest rates to go up. And so in that scenario, if interest rates went up and you were in an AAVE pool, you'd actually get higher interest than what you would get on AAVE. If you're just trying to hedge your risk and you want to sit in a fixed pool, then you would move into, you would buy that fixed risk off of it. So I think it's more a question about like UI than is there demand for like what we're creating. And then on the smart alpha side, that's also a pretty relatively easy to understand concept. The way it would look from a UI perspective to a user is either low risk like ETH or high risk ETH, or low risk Bitcoin or high risk Bitcoin. So I think that if you think about, I mean, what the real reason that in my opinion that AAVE had or has, I don't know if it's still the case, the highest TVL of any lending protocol is because the UI is way simpler. Like if you go to AAVE, it just says variable like deposit. Like when I was first learning these things, I went on like Balancer and was like, what is this? I mean, I have a deep background in crypto and finance, and if it takes me more than 10 minutes to understand, it's probably too complicated. AAVE, I understood it in 30 seconds, like how to use the protocol, right? So I think some of these questions about like, is the market ready for that? The question is, do we have the liquidity, right? Like assuming infinite liquidity, you could build infinite derivatives. And I think as we hit $15 billion, like, yeah, we have the liquidity to start like creating some derivatives off of this. I think that people that need to understand how these protocols work will, and everything's open source. So like if they want to review the smart contracts and see where the risk is, and then like the industry will look to these bellwethers, like people like Samsung that like they're starting to introduce like ratings, like where AAVE got the highest rating or like the safest protocol. Like people will start paying attention to other third-party people on whether or not these pools are safe or whether or not these areas are safe to be investing your money. And then I think past that, it really just comes down to UI. Like if you could log into a platform that said, I want fixed rate interest, or I want variable interest, or I want to buy into a low risk ETH pool or a high risk ETH pool, yeah, I absolutely think that the market would use those products.
Okay. Go back to Sid. So as mentioned, you are actually trying to create a bond pool so the people to get access to the liquidity. So in terms of the credit, so perspective, so in traditional finance, so the market is divided by, let's say, high yield, and for example, the investment grade. So actually, what's your method or a thought to, let's say, have different risk profiles for those kind of institutions or people to get access to the liquidity?
Is that a question for me?
Yeah, for Sid.
That's a good question. Yeah, I was on mute. So I think, I mean, generally in traditional credit markets, I mean, underwriting is not super complicated. You generally look at cash flow strength. So, you know, measures like EBITDA, margin, you know, what the leverage is in proportion, like as a multiple of cash flows, the leverage on their balance sheet, the size of the institution, management expertise and reputation. I mean, if you boil it down to those sort of 4 criteria, there's no reason why you can't translate that to institutions in DeFi. And most of the institutions that be borrowing through Maple, like your trading funds and market makers, they can provide that information quite transparently. Like they're highly financialized rather than kind of more opaque operating businesses. So the way that we would be translating, sort of checking that credit risk, is that you would have a party that understands the economics of the space. So this would be like a sophisticated investor or a fund who performs this role of what we would call a pool delegate. And so they're checking the borrowers, like let's say a trading fund that wants to come and borrow through Maple in an under collateralized way. They'd be checking them against this criteria, and then we'd arrive at like a minimum collateralization, and then allow the market to set the APY that matches that risk level. But in that way, you're able to give an institution that's got a good reputation, good cash flows, not too much leverage. You're able to give them access to this finance. They can go and reinvest that. I mean, at the moment, you can earn in a relatively low risk kind of way, you can earn yields above 20%, just playing the futures market and yield farming. So I would consider that a pretty sort of low risk proposition at the moment. But then with Maple, we're also able to offer this kind of structural management of credit risk, in that we have the Maple token, which you can stake to provide insurance across the liquidity pools. And then the liquidity providers in our liquidity pools are taking uncorrelated bets across multiple different borrowers. And then you've got these other exciting opportunities for composability, like with Tyler's product. Can we tranche out and then provide structural credit enhancement through having like a senior and a junior tranche in one of the liquidity pools? Or can we work with Andrey's product to have like a credit default swap for some portion of that liquidity pool as well? So it's really like, then you get to composability, or shield mining from AAVE's safety module. So like it's really like once you start dealing with this primitive risk, then you get to composability, and that's really the power of DeFi, isn't it?
All right, sounds good. So let's move on to next topic. So what's the driver of the DeFi? So I know Stani actually answered this question in another MA. That's because of Andrey from YN. And Andrey's answer is the greed. The greed of people actually trying to get all these kind of airdrop tokens. So my questions will be, what's your thought on liquid money? I think that's a very good incentive ways to provide to people who will use the protocols. But what do you think? Actually, those kind of liquid money right now is dominated by big wealth. Big wealth actually have the capabilities to mine everything if they have found opportunities from the pool because of the high APY. And also, it's really a fair game right now to provide to the community and also the people wants to use the token. And I know Tyler is going to launch liquid money next Monday. So then maybe we can start from Tyler. Actually, what's your thoughts on liquid money, and actually, what's your idea to design the incentive for people who want to mine the tokens?
So, are you asking what drives DeFi? Is that like what the question is?
So the question will be, what's your thought of the current liquid money? It's really a fair game right now because big whales with the large capitals can actually mine everything. So the second one will be, what's your own logic right now to design your own liquid money to incentive the early users of your protocols?
Yeah, so I'm glad you asked this because while on this call, I was actually just messaging someone else about it who said DeFi is a scam, and yield farming is a scam. It was actually it came off a pump, and like he lives in Raleigh where I live, and I know I've known him before crypto, and he got into crypto by Bitcoin mining, and I just don't understand how you could think that yield farming is a scam when it's essentially the same mechanism. What yield farming is a way to distribute governance of a platform. That's no different than the way than what Satoshi did when he started allowing people to Bitcoin mine. They were essentially mining the governance. I mean, the reason that Bitcoin has value is because it governs and handles the security of the protocol, right? Like, so there is no difference between yield farming. The reason that it has value is because it's governing protocols that people think are going to be valuable. So when people ape into these contracts, they should be aping into something that actually seems like a good idea, right? Like BarnBridge, for instance. Like if you can essentially have a protocol that helps you move in and out of risk across DeFi, then absolutely that's going to have value. So people are going to go into that contract and they're going to want to essentially govern it. The reason that you want to distribute governance in DeFi is because we are up against a very powerful cartel of bankers across the world that have politicians in their pocket all around the world. And we shouldn't have a single point of failure. I mean, the best thing that ever happened to Bitcoin is that Satoshi died or left without rug pulling, right? So like, if you look at DeFi, is this mechanism of yield farming to distribute things going to work long term? Probably not, right? Like we need to create some primitives in the market. We need to let those come to life, and then some new things need to get built on top of it. But is it a scam? Like, absolutely not, right? The other side of that is what's driving DeFi right now. It's not yield farming. Yield farming is helping, right? Because like it's driving up the yield. But the reason that DeFi is going to win long term is the same reason I said before. It's like a scientific law, if it existed in math and finance, is that working capital will follow yield. And right now, those smart contracts are more efficient than the people that are pushing paper on Wall Street, and they're not going to be able to compete with it long term. So it's not going to slow down. So yes, it is greed, right? But that's everything. It will continue to go after the higher yield, and people cannot compete with smart contracts like AAVE that trustlessly lend out money in seconds. Like it takes me less time to borrow money on AAVE than to drive to the bank, right? Much less get approved. So like, yeah, I think that DeFi is going to continue to win, and it's because of the efficiency that will drive up yield. And as far as our yield farming goes, I'm actually pretty excited about it because I got a message on this while we were on this call. We hit $2 million in TVL, so like total lock value, and we haven't started accruing rewards yet. So the rewards actually start on Monday. So people have we allowed everybody to front run the contract. So nobody will ever say there's a curve scenario. Published it 5 days. Everybody had more than enough time to look at the contract, do the security audits. So we do have people front running, but they're going to be just as valuable as the next person. If you're in on Sunday evening at midnight, so Monday morning, like it says it on the UI exactly when it starts, then your dollars are just as valuable as my dollars.
All right, okay. Stani, what's your thoughts actually after probably 1 or 2 months? I saw the yield mining space, the API has come down a lot. So what's your second thought on the current mining right now?
Yeah, I mean, it's been an interesting period. I mean, kind of like I think I used to think, I kind of understand Andrey's point about that the grid is the one that drives the space, but it's actually not that true, because the grid is temporarily, and it boils down to an excitement of something that is happening in that sense. So I think like what drives the whole DeFi space is basically the innovation. So when stuff is innovated and efficiencies are removed and accessibility is created, that creates yields. I mean, for example, if you have a global space where you can access liquidity from places where it was very difficult before or even not accessible, of course that liquidity increases in value in that sense, and it's repriced. And I definitely think it's what is actually like drivers, and we see that value in the pricing. So let's say when last time before the liquidity mining, when DeFi was very interesting, like it was roughly over a year ago, when there was roughly 20,000 users in DeFi approximately, and you could earn 5 to 10% on stable coins and interest, and that was a big thing, and many started to build different kinds of fascinating products, like in terms of like started to promote DeFi as better alternative than your bank offers you. So you kind of started to see a lot of things there. So I definitely agree with what Tyler said on this. AAVE itself hasn't had like liquidity mining programs. Not that we don't like them or nothing like that, but basically just kind of like our model has focused more on the safety module staking for the token holders that are participating in governance and making risk-based decisions to take that risk to themselves, and that way kind of like provide more safer kind of like a protocol, and that way get more adoption. And I think for us, it's more important to keep the protocol as safe as possible, so people can store their collateral there and get yield, and everything can be built on top. And many yield farming programs has really helped AAVE quite a lot, because I mean, some of them are related to AAVE, for example, in various ways. I mean, one of the pools in Curve, deposits are going from Y pool directly to AAVE, and bunch of other stuff. So yeah, I think it's the innovation that drives and kind of like more efficient markets, would say.
Okay. So then what's your thoughts, Sid and Andrey? So I know you probably haven't launched anything related to the group mining yet, but probably you have some thoughts on top of your mind if you are going to do that or not, right?
Well, first of all, I said grid in sometime, but it was not so much about liquidity mining. It more about like the current situation in DeFi, and it's a lot of scam as well. So, and there grid is very important. And if we talk about legit products and good products, I tend to agree with Stani. It is innovation, it is efficiency. So it's indeed, I can drive to the bank, but I can also use DeFi products, and it's pretty cool, pretty exciting. So it's not like, I wouldn't say greed when we speak about liquidity mining. And what is pretty exciting for me, it's like of giving the power to the people, so giving governance to the people. I think it's pretty cool, but again, I'm always thinking about risks. The first, I'm thinking about excitement, but then I need to think about risks. And the risk is that people can, well, let's take Uniswap. Everybody got Uniswap, 400 Uniswap tokens, and it's pretty amazing. I just wish much more education, because a lot of people, they were selling it and they don't understand, they don't realize what kind of power they get. And that reminds me a lot of experiments over the last 200 years when the governance of something was given to people. And I was born in Soviet Union, right? And then in 90s, they gave all the assets of Soviet Union to people, but people did not manage it properly. And they had no clue what does it mean. Everybody got the same share. Every citizen got the same share of all the communistic property. But then after a while, we end up that we have these oligarchs who accumulate all these assets, and yeah, now they basically own it, because people were not sure what it is, how much it should cost, is it valuable or not, and if they see short-term benefit, they were trading it immediately, not realizing the long-term. That's a risky part. So I agree about innovation, capital efficiency. I don't like scam, and it's purely driven by greed, but also thinking of risks and education of the end user. They need to realize what it is and how to use it.
What do you think current finance is driven by if it's not by greed and yield? I mean, it's kind of all the same thing, right? Like,
well, greed.
Okay.
What does it mean? Greed. Greed can be like be more capital efficient and earn a little bit more, but greed also can mean that I want to put all in and become a millionaire tomorrow or lose everything. So that's different degrees of greed, right?
It's just different differences in degree of greed, but we're all kind of driven by self-interest. But I think my thought on yield farming is, I agree with Tyler. Like, I mean, effectively, yield farming is a mechanism by which you distribute the governance of the protocol, and you try and do it efficiently in a compressed period of time to a wide subset of people. But I think the main thing you have to think about there is there's kind of three things you want to get out of yield farming. One is the distribution. Two is the participation. So the way that you distribute to the different subsets of your users, you want it to go to the people who will participate the most and add the most value. So they should end up with a higher allocation. So that would be how you choose to distribute it, by the different roles on your platform. So, you know, we've got borrowers, liquidity providers, people who are staking the Maple token, you know, that they all provide different functions, but you want them, you know, you want them to be incentivized with to participate and add value to the platform. And then the other thing is obviously it's kind of like guerrilla growth marketing almost. So you're providing an additional yield for the people who are going to take your product from, you know, 0 to 1 in terms of user adoption. So it's almost like a marketing spend in that case. So I think it's useful. I mean, yeah, sure, it's driven by greed, but it's super useful in ensuring growth and proper participation, and actually setting up your protocol for long-term success.
I see. So then we probably ran out of time, but I'm going to have last questions for all of you. So then you all built on top of Ether. And so you know actually how Ether works. So during kind of the peak volume transactions, probably back in July or August, the gas fee is super high. And also sometimes the block meets the congestions probably will jeopardize some of the protocols, especially for those have the liquidation mechanisms. So if there's some delay on that, maybe will jeopardize a lot of the liquidity on the pools. So then Ether2 is coming out. So then what's on your thought? Actually, on the base level, so then it will be solved. So then on top of that, so the project or the protocol can be improved. So maybe we can start from left, Andrey. So then go to right.
Yeah. Well, I think it's pretty positive problems that we run in. It's those are problems of growth. It's not a problem of depression or stagnation. It's we grow too much, and that's good. So that's good problems to have, let's say. And it can be Ethereum 2.0. It can be ZK rollups. Maybe it's going to be some bridges to Solana or to some others. And Neo Protocol is doing quite good work. So I personally think that, well, first of all, we should choose, or at least that's what we believe. We should choose the best technology. If it's going to be something else than Ether, then we should go for it. Or it's going to be bridges, yeah, we should go for it. That's one thing. And another thing, it's a lot of activities on the blockchain on layer 1, which maybe not optimal to be there, like automatic market making. And it's naturally expensive now, but automatic market making is can be done perfectly on layer 2. It's called algo trading in traditional finance. And it can be 100 or 500 different strategies to do this algo trading or market making. So Uniswap is a very primitive one, but you have a lot of different options, and they all have right to exist. And that's another reason to high gas costs. So I think two things. So technology will just develop, and it's good that we have this problem. It means we grow too fast, but it's also naturally will shift different activities from the layer 1, which doesn't need to be there. We don't need to be there.
Okay. Okay, Sid.
Yeah, I mean, I kind of agree with Andrey. Like, it's, I mean, it's a good problem to have growth. You know, some of the things that, like, I'm involved in a couple of DAO projects as well, and they look at, you know, side chains like XDAI as far as scaling solution goes. You know, then like there's a lot of focus around optimism. So I think, you know, the community, like, as Tyler said, you know, people are motivated by greed. So, you know, if we can improve the yields by moving to, you know, moving to a better sort of scaling solution and have lower transaction and gas costs, you know, like the community is naturally going to build in that direction. So yeah, we'll follow where those projects start to go.
In this scenario, we kind of want there to be a little bit of greed, though, right? If everybody's so altruistic, like, why don't you just give us all your ETH? Like, there's some aspects of greed that uphold the security of networks.
Oh, 100%. Yeah, I'm fully on board with that.
Okay, then Stani. I think you probably have the largest user base and also the volume involved with the project. So then, actually, what's your thought on that?
Yeah, I definitely think that it's not very optimal to settle all transactions now in the way we do in Ethereum, the mainnet. I could imagine that you could settle transactions in like kind of like bunches in terms of like rolling up with rollups. And I think, you know, Ethereum, the whole blockchain is all about security. As for example, Tyler said that you know, Bitcoin mining is the same thing as DeFi. It really is. I mean, it's just providing security for the network, and in DeFi, Ethereum is providing security to the whole Ethereum network. AAVE is providing security in the AAVE smart contracts, and so forth. So the kind of like logic and incentive is the very same. But I think to get all of those transactions, they don't need the same amount of security, you know. And some of the stuff might require less, and then when you need to settle, you could settle it to more higher security. So I think like layers will make a lot of sense, and we're currently researching quite a lot of this topic and trying to figure out basically where to start and where could the liquidity go as well, because AAVE is a protocol that follows the issuers, whether it's stable coins or whatnot, assets, and also the traders, so where the swapping happens, and then we can deploy infrastructure for lending there, because we need market price discovery for the collaterals and liquidity. So it is important. And after we solve that, the next thing is the privacy, and and that is also quite an important topic.
Okay, so then I'm going to let you actually each of you to have one sentence to finish this topic today. So in 1 year, what do you expect your project to play in DeFi?
What was that?
In 1 year, next year, we are going to have the same probably MA at next year. So what do you expect that your project to play the role in DeFi? Okay, let's start from Sid.
Okay, I'd like to think that we're providing in 1 year we're providing like a primitive where corporates and institutions in the crypto space are now brought into DeFi rather than using CeFi instead, and that we're therefore bringing in more liquidity that can then be used with like the composability and the money Legos of other protocols, like BarnBridge, like Opium, like AAVE.
Okay, Andrey.
In one sentence, more capital efficiency and risk efficiency.
Okay, Stani.
1 year is a very long period.
Yeah, 1 year is very it's very long, but you made a lot of progress in 1 year.
Yeah, I think we'll be happy if we kind of like see DeFi space to not stabilize, but maybe kind of like move to a point that is quite secure in the eyes of, let's say, retailers, institutionals, and there's a lot of this kind of like experimentation that will be super happy. And if AAVE will be kind of like one of the key protocols to achieve this, that will be pretty awesome. Yeah, that's it, I think.
Okay, Tyler.
Yeah, I would say I agree that 1 year is a long time, but I mean, we have a roadmap that within 1 year we need to get both of our products like out to market. So we essentially are going to be spending the next year both managing the products that we create and making sure that there's not security vulnerabilities, and then also releasing like the ones that are built on top of it simultaneously. So I would hope for BarnBridge that where we are in a year is just executing on like the path that we set out.
Sounds good. All right. Thank you everyone to join the MA today. So then have a good day for the rest of the day. So I'm going to publish online and let you know. All right. Thank you.
Thank you so much.
Thanks, guys.